If you've been watching the precious metals market, you've seen the recent volatility. The sharp pullback after gold and silver roared past major psychological barriers. Back on September 21st, I came here to warn everyone we would likely experience this price volatility and a pullback around the $50 price level for silver. I even followed up on October 5th with Jordan from the Daily Gold to reinforce that warning. My analysis suggested we could expect as much as a 19% pullback after silver hit $50 an ounce. It was based on this analysis that I took 10% off the table on my mining stocks, capital that I planned on using to purchase physical precious metals on the dip. Unsurprisingly, that message was met with a mixture of disappointment and even pushback from some of our regular viewers. They insisted that silver would blow through $50 an ounce on its way to hitting much higher levels before the end of the year. I completely understand the reaction, because there was a lot of excitement, a massive euphoria, in the metals community as silver went above even $54 an ounce. For a moment, it looked like nothing could stop the price from continuing upwards as stories of shortages, which were and remain very real, popped up all over social media. But this video isn't about saying I told you so, because the truth is, we went a lot higher than I had expected before seeing the pullback. What this video is about is an updated response to a viewer question I received from DS8607 at the end of September. They asked about my timeline on the metals pullback and what I think will happen in April 2026. To answer that, we're going to start from the pullback itself. What is causing it? Why it is actually a good thing for the long-term price structure, how long it may last, and how low we may go before we see gold and silver prices make a reversal and start moving up again. Once that's covered, I want to talk about April 2026, why I think it is so significant, and show you all what the data is telling us about that date, and why, historically speaking, it suggests that much higher prices are still on the way for both gold and silver. Now, what I am seeing right now is very similar to what I saw at the end of last year when I made this post on X, saying that silver's pullback after bouncing off of the key $35 an ounce resistance level could take us back below $29 an ounce before bottoming out. Sure enough, we visited that price area not once, but twice before shooting off to nearly $55 an ounce exactly 1 year later. Just like that pullback was beneficial for silver's price development and set the stage for the massive move up to $50 an ounce. These recent pullbacks that we're seeing for both gold and silver are no different. These pullbacks, which I believe are coordinated and orchestrated, essentially stomp out and flush out what I call gold and silver tourist money. This is speculative money that drives prices higher, but is not based on any real investment demand. It's simply based on people trying to make a quick profit. These sell-offs, whether they happen via the sale of paper gold and silver that doesn't exist, or by naked shorting, which I described in a recent video, they are designed to trigger speculative stop losses. These are sell orders that are executed at specific price levels to protect speculators from losing their money in the paper market. When you create enough selling pressure in the market, these stop-loss sales get triggered, adding more selling pressure, pushing price down enough to trigger the next set of stop-loss sales, and then so on, creating what is called a cascade of selling in the market. Once that speculative money is cleared out, real investors, including the institutions that often create the environment for these major price slams and these stop-loss cascades, they essentially step in and they start buying the dip. Switching over to a chart for gold, this is a great example that shows us exactly how this has worked in the past. If we look back to October and November of last year, when the price of gold pulled back 9% over 2 weeks, and people were once again calling the top of the gold and silver market, what we saw was, and I don't think it's going to be any different this time around, that big money, including central banks, stepped in to buy that dip in gold price. As the data from the World Gold Council shows, central banks actually made their largest gold purchases of 2024 in October and November, during that price pullback after the speculative money had been flushed out of the market. This is the systemic perspective that matters. The volatility is the system resetting to prepare for the next major move up. Now that we understand what is happening and why this is actually good for the bullish development of gold and silver prices, we have to cover how long this is likely to last, and how low we may expect to go before turning things around. To start, I'll say that I expect more consolidation, which is sideways price movement, and volatility heading into the end of the year as we reach bottoming out levels, likely in November. We also have the possibility of revisiting those low levels again in early 2026 as some people realize their big 2025 gains in both metals and mining stocks in early 2026, so the capital gains on those profits get pushed to the 2027 tax year. That's just a heads up on what to expect in the worst-case scenario. That said, I expect to see a solid turnaround happen no later than February of next year. That's just 4 months from now, although I admit it can start earlier than that. The key takeaway here: use this pullback as a window of opportunity to prepare yourselves instead of waiting for a magic number to hit before you buy. Because although I think in the case of gold, we could come back as low as $3,750 an ounce, which is at the 50-day moving average, we may not see it come back that far. We may only see a roughly 9% pullback off the highs, like we saw last year, taking us to just below $4,000 an ounce before the turnaround starts. Now, in the case of silver, where I previously said to expect a 19% pullback from around $50 an ounce, I have to factor in the higher price level that we achieved in the recent run-up. Meaning, we may only pull back as far as $44 an ounce with an outside chance of retesting $40 an ounce, which is at the current 100-day moving average. That is realistically what to expect. But again, I want to warn you that pullbacks to those levels may be extremely fast and difficult to buy. In fact, they may not even be buyable at all, just like the pullback we saw on silver below $30 an ounce in April of this year. So, stay on your purchasing schedules because new highs are coming, and I am going to show you exactly why. Moving on to what I think is the most important part of this video. Why did I tell DS8607 about a month ago that I expect silver to make its move to $60 an ounce in April or May of next year? And why do I think it may also coincide with gold breaking above $4,500 an ounce? The answer connects global monetary policy directly to your wallet. To start, the US CPI, which is the consumer price index that measures increases in the prices of goods measured in US dollars, hit 3% this week. As Wall Street celebrated it, because it came in below the estimated 3.1%, I was telling people in my Discord group that this is a big deal for gold and silver. The reason is because this result, which the market interprets as good, has reinforced expectations for more rate cuts in 2025 and early 2026. According to the CME Fed Watch tool, this now gives us a 74% chance of seeing U.S. interest rates at 3.5% or lower by March of next year. For those of you who know where I'm going with this, alarm bells should already be ringing in your heads, because that means that as of the March 18th, 2026 Federal Reserve meeting, we could expect to see real official interest rates for cash savers at or below 0%. Why? Because the interest rate offered to cash savers minus the official CPI inflation rate, which we know is understated anyhow, will give us a real rate of 0% or lower. That means anyone saving in cash or holding certificates of deposit or buying U.S. Treasury bonds immediately lock in a loss. And smart money, big money, institutional money, including central banks, are not going to tolerate that. As things stand today, the 1-year real interest rate is at a pathetic 0.7%. And again, if you factor in real price increases on top of what the CPI says, it's probably negative already. But the majority of the market operates on official data, and that data says it's still positive. But once that number goes negative, like we saw happen 6 times between 1970 and 1980, and then another 9 times after a long break starting in 2022, gold and silver prices are going to make massive moves up. The massive moves up in gold and silver prices are a historical certainty in this environment, as we saw following the late 1973 move to negative real interest rates when gold price shot up 54% in the first 3 months of 1984. We saw it again in late 1979 when both gold and silver made blow-off top highs, and it is no coincidence that we saw it ignite a new metals bull market in the early 2000s when real interest rates officially went negative again after a 22-year break. The mechanism that causes this is simple. If the global financial system is based on the US dollar, and we know that is still the case, and you are guaranteed a loss by saving in that currency, the US dollar, then the only logical thing to do is to move to an alternative that will protect you against that loss. And today, as has been true for more than 5,000 years, real money, meaning gold and silver, is the place that people move to get that protection. This is why gold and silver prices, every single time since 1971, when the United States went off of the gold standard, have gone up every single time. This happens either in the quarter interest rates went negative or in the following quarter. The average increases for both gold and silver for those periods immediately following a return to negative interest rates are substantial. What this data tells us is that if we are to consolidate around current prices, which is what I expect us to do with a few pullbacks along the way, we should hit new highs at the latest. And I mean at the latest, it could happen earlier, but at the latest in April or May of 2026. By that time, gold should be breaking above $4,500 an ounce, and silver should already be starting its move up to $60 an ounce. This is why I am watching what the Federal Reserve will do this next Wednesday very carefully. The real economic revolution isn't some abstract concept. It's the moment when the system's guarantee of value erodes, forcing a move to real assets. This is the systemic perspective you won't get on mainstream news, connecting a CPI number to your future wealth. I want to thank DS8607 for the fantastic question that led to this follow-up video.